Well, welcome everybody to another Pepperstone live event, and what a one it is today. We've had tariffs, we've had huge, big volume, and of course trade activity across all pairs. And over the last week, we've seen one of the most volatile markets on record. In today's video, we'll go through how do you handle such an event? Are there trading strategies that you can use to potentially maybe benefit from these types of situations? And of course, what are we looking at right now? Today, we'll go through a live and interactive kind of look at all of the major indices, commodities, and of course, cryptos and currencies. My name's Thomas Atkinson. It's great to have you here, and we've got a lot to go through. Tyrone, what a week it's been. One for the history books, certainly one I will not forget. I feel tired already.
Yeah, we are tired. Look, it's been a very, very big week. I mean, yeah, Eddie McGuire used to say it's always been a big week in football from week to week. Well, boy, oh boy, this webinar compared to last week's webinar, the market is just on a different planet. And realistically, look, there is a cause and effect, of course, for everything that happens, and it's certainly made for interesting trading. Like I said, the VIX. We will touch on the VIX today. I know it's something that we don't often look at because we really haven't had reason to, Tom. It hasn't been, although we've had a volatile year, we haven't seen the volatility spike like we've seen over the last week. So look, let's jump into the markets and see if we could actually see anything that makes, we'll try and make some sense of what we're actually seeing and see if there's an end to the madness.
Absolutely. We've got Stuart, as always, and Silvio in the chat. Guys, if you have questions throughout, please ask them in the chat. We do answer them live here in the analysis. And obviously, if you're watching in the replay, then make sure to comment down below. We do read those as well. Thank you so much. All right, well, let's begin by talking about what I like to always discuss, which is the VIX, the volatility market in these kind of situations, as you said, Ty, and then also correlation. So let's begin here with US 500, which dropped drastically over the last kind of week. I mean, it was really just in free fall since quote, I guess, Liberation Day. And of course, we've seen tariffs, escalation of tariffs, reciprocal tariffs, all sorts of things have changed in a week. One of the most eventful ever recorded. Now, what happened was that the markets actually came down and broke underneath some of the key lows. For a lot of people, 49.50 was a super key low. And of course, markets, found those levels and basically found some buying pressure just underneath them. But I would say a lot of people had stop losses below here, Ty. And what we saw was a kind of market that was hitting key levels across the board, whether it was the NASDAQ going underneath 17,000 and then breaking down to 16,200, 300, whether it was gold or silver going down to that 3,000 level on gold, or of course silver getting into the 29s. All of these zones started to hit at the same period. It's what we call correlation across the board. So for now, it looks like we've made small time structure. And there was a trade. And before we go to the VIX, I'll just show the one that I thought was best anyway, which was the Monday session. So we opened with extreme fear. And of course, we found this kind of gapping zone down here. We rallied, which makes a peak. And then, of course, we dumped again, back down to the lows. And then we rallied again into the open. Now, does anyone know in the chat what type of pattern this is if you're a pattern-based trader on smaller time frames? And no, Tyrone can't answer just yet. But yeah, we did see a pretty interesting pattern here come on the 15 minutes. And this is kind of where we've got to be. A few people saying double bottom. Absolutely. This is where we've got to be at the moment, doesn't it, Ty? Small time frame structure, understanding markets, understanding liquidity grabs. It's a second by second news based market, isn't it?
Absolutely, it is. But look, I probably will, preface this by saying the actual way to trade this kind of market is short and sharp. And when I say short, I don't mean just selling. I mean, getting in and getting out quick is what I'm talking about by short and sharp movement. But really, if we can go back to a weekly, again, Tom, just for a second on the S&P 500, the signs were there that the exact reverse of what we're talking about on the 15-minute chart there is there for all to see in reverse, which is the double top on a weekly chart. Now, even prior to the madness, let's call it the madness of this week and a little bit of last week as well, we were already in a downward market, right? Like there's no question about that. We'd already seen the weakness start to prevail on a lot of the key indices, not just the S&P 500. A lot of the major indices around the world were starting to weaken. So we're not totally surprised. Look, we're not going to sit here and pretend we thought the market was going to go to 4,800. Like anyone who's saying that, that's just ridiculous because we wouldn't expect a drop like that. That's did we call it an orange swan event? Is that what it is now?
There's some pretty funny meme. Going out
It's
there.
an orange swan event. Yeah, but the market was already in a downtrend, okay? And I think it's really, really important to acknowledge that because it's a lot easier to trade in the direction of the prevailing trend. And that pattern played out beautifully, by the way. So, yeah, I know we've talked about it, well, several weeks ago now, but it was there. There's no question about that. And not only did it break the neckline, but it came up and retested it from below. Absolute classic double top pattern. But look, it fell far, far further than most people would have predicted, unless you knew that these tariffs were actually going to come out. If we knew what Liberation Day was going to bring us, Tom, last week, I think we could have preempted the downfall of the market, because I think anybody with half a brain would have been able to work out that blanket tariffs were never going to be good for the market. It was never, ever, ever going to go up on that sort of news, because that was never going to happen. So if anyone knew that information and knows what's happening in the future, please let us know, because it would be a very handy thing to know. So that's what caused the market to obviously fall way, way past what we would have expected. But the fact that it actually got to 5,500, which is really where the target would have been for most patterns, that was really straightforward, wasn't it? Like up until then, the TA was very, very sound. What happened after that is not really a TA event. We've got to be realistic about that. And like we've said all this week, actually, I know you have said the same thing, Tom. This is a man-created crash, and a man-created crash can be reversed by a man-created V-shaped reversal. And that's why you have to be very, very, very careful when you are trading. And that's why we emphasize the short and sharp maneuvers, to make sure that you're not setting long-term positions and hoping that it's just going to work out if you're trading like a scalper. Now, if you're trading like a long-term investor, that's a very different story. And I think, and Tom will attest to this, that we're seeing some very, very good levels for someone who's an investor who wants to add to their portfolio. There are some very key levels here that have been hit. You're not going to go too far wrong, starting to enter the markets at some of these very important levels like 5,200, 59.50, and probably to 58.50 at a stretch. But
you mean 49.
49, sorry, 40, back in the 40s. 49.50 and 48.50 are the levels I'm talking about. I know it's crazy to think that we were up 1,000 points not that long ago. So, these are levels where potentially, as a long-term investor, there could be some good opportunities. But from a trading standpoint, absolutely what Tom was saying about the 15-minute chart, onto the smaller time frames, look for those patterns in and out, and they do present, because when the good thing about extreme volatility and very heavy support and resistance zones is when the market is confused, it gravitates to those zones.
Well, let's talk about the gravitation right now. So 4,800 is basically the gravitation. We've seen a series of lower highs and lower lows over the last 24 hours. And then, of course, we risk rallied there during the London session, back end of Asian session, and we've basically seen here a higher high being formed. That's kind of signaling that, at least for the short term here, somebody's trying to buy this dip tie. And scalpers and day traders, of course, will be looking at that. It's very similar style setup to the double bottom the other day, happening at, funnily enough, around the same area. But it hasn't just been that in the markets. One of the things I traditionally look for is usually correlation between multiple pairs. You can see the Nasdaq's got the same. But it's also been other markets such as silver and gold. Before we get there, though, let's just have a quick look at the VIX. So what Ty said before is short and sharp is because of this. When you see the VIX up here, you can see here it's an extremely high read. We do not get this very often. If you actually go back through history and you look at all the times you've seen a 58, 60 VIX, this is traditionally where you usually start to see markets have peak fear bottoms. And that's, of course, worthwhile. It doesn't mean it is the bottom. It can still fall 10%. It can fall 5%. But traditionally, it's been close when you get these types of levels. So that is also worthwhile keeping in the back of your mind, at least the initial fear drop anyway, and then maybe markets can degrade from that point. But this is not actually necessarily the only one you need to use nowadays. You can use the VVIX, and because we went to 0 DTE, which basically means that we've got these more frequent optioned expirations, a lot of people use this one now, which is the volatility of the VIX. And again, you can see very high, incredibly high volatility across the board. And this is just telling us that, it pays to be short, sharp. And obviously, we saw fake news literally this week, Ty, that moved the market from -5.5% to 5% up on semiconductors in the matter of minutes, pretty much, because of a release saying that the tariffs would be supposedly, postponed for 90 days. And that turned out to be literally not real. So, you know, algorithms are trading on these releases, and this is the type of thing. It's very, very quick. So be careful out there and make sure you've got your eye set on VVIX and VIX in general to know that this is a volatile market that can change like this.
Absolutely.
Any other points on VIX, though? Yep.
No, I think it's very self-explanatory. Look, we haven't looked at VIX in a little while because there hasn't been any reason to, but obviously we need to pay attention now. But look, again, and you're going to hear it a lot tonight. Yeah, this can be reversed very, very quickly. So just be mindful of that, okay? Don't get caught out. And I think that's the key. This VIX was, moved by decisions, not by an occurrence or an event. And there is a very, very big difference. Very big difference.
Agreed. Now, one of the markets that we spoke about correlation before, and one of those markets was silver, which was coming down to this very important 29.50, kind of 29.30 area. And what we saw was obviously it got volatile down here. Just make sure you guys can hear me still. I don't know, it came up with some strange volume microphone thing, but anyway, I think we got that sorted. Okay, good. So basically we have this really key support here, and you'll notice that this found buying pressure. Now that's important because as you scroll down through your timeframes, you're going to see that there's build structure. So we went low, lower high, lower low, higher high, at least very small time frame. Again, if you go into a 15-minute, which is where we kind of are right now, the market then has stabilized. And what this is telling us is that if the market goes back above these highs, it's kind of pressuring that idea of a relief rally coming through. And I'm seeing this through silver and I'm seeing it through gold, Ty, which is basically that markets have kind of pulled back, recovered, found kind of some key zones in here around that 50% fib, etc., and effectively stabilized. And this is really key for day traders because you'll notice, and most of you are probably going to be more interested in gold, you'll notice a similar occurrence here. Lower low, lower high, lower low. Will we get a higher high? If we do, we're changing trend potentially to the upside here on smaller time frames. So some good structure starting to form, some big breakouts potential. And I've got 3,055 at the moment as a key point of resistance for us to look at.
Yeah, I think gold is actually coming to the party, isn't it? I mean, it looked like it was a bit dire there for a little while, and I thought, oh yeah, we're a little bit shaky, but you know, it's come good in time. Recovered like the rest of the markets recovered. I can see gold making a new high actually. I don't mind gold for the new high because I think it didn't fall to the extremes. Obviously, the rest of the market fell. But I get the feeling that if the market recovers, Tom, gold's going to go with it. It's going to reap the rewards of a strong market or a stronger market recovery. And I think if that happens, we're going to see 3,300 gold very, very quickly.
Yeah, so gold's going to be reaction here, I think, to liquidity in markets, which has started to suffer over the last 24 hours, more notably. The idea of this 104% tariff, not that we're here to talk about this macro stuff, but that came in, and then what we started to see was bonds market struggle. Obviously, that can help hurt gold, but as Tyrone mentions, if we get recovery, people are going to start piling in on geopolitical kind of like geopolitical turmoil style trades, which are going to be things like gold and others. So liquidity improves. I would see gold, silver, and I find it interesting that both of them have kind of basing structures that are starting to form. Of course, are they out of the worst yet? Well, no, not necessarily, but we're just starting to see this across the board. I mean, one we're not seeing it on is oil, for example. Like, have we seen silver and gold improve? Sure, but oil is getting slammed. And I'll say this: if you're someone that drives a car, Ty, I think especially in Australia, if you go and fill up next week, it's going to be cheaper than this week. That's for sure, because it's about 2 week lag, I think.
Just in time for the Easter holidays. It's fantastic for all the families out there.
You might be getting $1.50.
Absolutely. I would say, look, we certainly don't want to turn this into tariff talk, because I think what we're going to call it now. But when
it is a tariff discussion, so yeah.
It is a tariff discussion, but we don't want to make it all just about macro, because that's not why we're here. But one thing I will say about it, I think you probably want to keep this in the back of your mind. The people are asking the biggest question we've had this week. Is this the market bottom? Is this the market bottom? I mean, I've heard that about 15 or 20 times a day over the last 3 days. Look, the one thing I would say to that is that when we're starting to talk about 104% tariff on, probably one of the biggest exporters in the world. It's probably, I think the chaos is probably coming closer to an end than it is than the beginning. I mean, at that point, I think the retaliation will happen, and then I think they'll come to the party quicker. And in a way, for the market, isn't it better that he doesn't muck around and says, you know what, I'm just going to be silly about it and put 104 on instead of saying 40, 50, 60 like an auction? Like he's just gone all out and said 104. It can't really, I mean, I don't want to say it can't go further because, I mean, anything can happen, but more than likely a ridiculous number. It's like someone coming in at an auction, Tom, and saying, I want this property so bad that I'm going to go 500,000 over the next bid. So nobody comes near.
That's what happens on the block.
Yeah, it happens on the block. And and that's probably, and look, and it's kind of like, look, we've got to understand that President Trump, first and foremost, is a businessman and into real estate. This is how he deals, right? So, when you're coming in for a wipeout blow, I would like to think that would probably mean that chaos, or the chaos is going to start to drop after that. I think it'll settle down quicker rather than being driven slowly. So with a little bit of luck, that's going to mean that the market will stabilize soon. And I think that's probably something to remember, unless he comes out with 208% tariff in the next couple of days, at which point we better all run for the hills. Because someone said that iPhones are going to cost us $9,000.
Yeah, I did see that. I did see there was like a $2,000 or $3,000 or something dollars a phone, or $4,000. Well, one thing's for sure is that if you look at a chart like US oil, I certainly wouldn't be trying to pick the bottom right now. This is totally different to the structure of the other ones. And I just want to, I really want to highlight this, the massive difference in structural highlights. So when you come down, you go to a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, a barely wicked above kind of high, which didn't hold pretty much any time frame, which is key to note there because it's very important. It does hold some time frames. And of course, series of lower lows and lower highs. I don't know how low oil possibly goes. I mean, obviously, it can go very, very low. We've seen in general recessions get absolutely slammed back into the 30s and 40s. But I'll tell you one thing, Ty. This is one of those things that's going to, potentially push a 50, 52 would be the next level. I don't really see any support here for oil at this current level.
No, I think somewhere between 50 and 55 is the baseline for it. Like, I think, somewhere 51, 52 is probably the most traded zone. And you're talking about back in 1920, by the way. Like, you're talking about 2019, 2020, and also around the peaks there of 2017. It's been a very, very long time since oil's been down here. And, how important that historical support is going to be. We're a very different planet, 5 or 6 years on than we were in 2017 in terms of oil. So I'm not even sure how that is going to hold up, to be honest. It's just one of those. That level was important back then, but oil was different back then. The advent of the electric car. If you could count how many electric vehicles and how many electric manufacturers there are now compared to 2017. I think the differences are going to be very, very stark. And I know oil is not just about motor cars, but it is one of those things where, we've got to be mindful about that support way back then, how important it really is now. And I think it's all we can work on. But I would not, oil is not one of mine. At the moment, I would be leaving it alone. And we have said, and we've been saying for quite some time that if it breaks $65, it could drop $10 very quickly. I didn't think it'd drop $10 that quickly. But no. It doesn't seem to me that there's no catching it, and it wouldn't be a crazy surprise to me if it's back in the 40s.
We often get asked, how do you even get involved in these types of crazy trends that are on the downside? Usually the best way to do it is moving averages, anchored VWAP, that kind of thing. So if you add anchored VWAPs behind some of the previous highs, you'll start to build cases. Generally speaking, I'd probably put it behind these highs. And then if it comes back to these zones, if the trend is actually already, very, very strong to the short, there's a good chance that at least some shorting will occur around these areas. So anchored VWAP, that's certainly one of the top tips for today that you can put on your charts, especially in these aggressive ones. 20 moving average, find the key time frame as well. Sometimes you'll find like maybe a 2-hour 20 seems to be kind of the one here. 2-hour 20, you can see is holding it down, and that can become kind of like a consistent thing. So you can see once you see it once you see it twice, then you can continue that kind of downward momentum, upward momentum, depending on the trend. So we've got yields up across the board in the US as these tariffs go into place. At least the general thought process is inflation first, and that is pushing the dollar around as well. So we're seeing the dollar show strength and weakness and strength. I don't think it really knows what exactly it wants to do. I think it's confused by whether these tariffs will be on or off or what's going on. We've also got a lot of bonds as well that are coming to markets. So yeah, I would say the US dollar is a very tough trade right now. And unfortunately, because as Byron said what he said, which is to change very quickly, we could be snapping our fingers and then all of a sudden something gets wild over and completely switches. So be careful there. Let's have a look at the Euro US dollar, which is where most of you will be trading. And that's a little bit of a different case. You can see here it's just continuing that stronger trend towards the upside. And as you go down smaller timeframes, you'll notice that it's continuing to make these higher highs after consolidation. So that, for now anyway, I guess as long as the euro can continue to hold trend, which is holding these lows and holding these lows, then it seems to be still in a relative upward trend here, and the US dollar is relatively speaking downward, unless proven otherwise with crazy tariff results. I think currency is a little bit harder, Ty. Would you agree?
Yes, I totally agree.
Yeah.
Yeah, look, it's one of those ones. I mean, yeah, indices are affected, but nothing's more affected than currencies. I mean, when we're talking about global, events that are basically, economy, shaking events, nothing's going to be affected more than a currency, right? So, and the problem with currency is there's 1,000 moving parts that actually make up the movement on a daily basis. So it has a complexity that, pay grades far higher than ours need to decipher. So I think there's some of the hardest trades right now. Currency would be the hardest one to trade.
Wait for replication. Whatever your strategy is, you'd want to basically just know your stats on it, and then you just replicate the way through. But sometimes the trade is no trade at all. And as Tyrone said, there are many different parts. That's the key here. So because there are many different parts, what we tend to end up getting into is basically a market that is trying to absorb tariffs, what this means. And this is actually where it is often affected because you get a lot of swap differences between trades. So I would say that's why the currency market's a little more difficult until we get certainty here. And when we get certainty, I would say there's going to be some excellent trends that you start to see play out over the next couple of months. So sometimes it's just recognizing, what maybe it's more clear cut actually. Stocks, currencies, indices could be a little easier. So we've gone through gold and silver. They seem to be finding some form of potential base. We've got the US 500 NASDAQ obviously trying its best to hold this current level. Again, guesswork a little bit here because we're looking for technical replication. And then we've got the US oil falling off and currencies sitting where they are. So other potentials here have been, of course, the world markets. And I'll just show you the Hang Seng here for a second because it sold off in epic proportions. And what actually happened was the market actually dropped, if you can believe it, in one session. It dropped 15%, 16%. So that's a wild sell-off in any index, especially a big one. And when you go and you look and have a look through, what we've seen is a real capping of the most traded zone. So effectively, the Chinese markets, what they've seen is, of course, these massive tariffs that hurt, but at the same time, we've got a stabilization as we're seeing liquidity being promised to the market. So a very interesting point here for scalpers and day traders to be observing the way the market is acting. What I'm seeing right now, Dai, is the 3 lower lows that are all very close. This is what we call a dull market. And it can sometimes be a basing structure as well, like a Wyckoff basing structure. So we've got that lower low, basically a selling climax, and then we've got extreme sells here that tend to wipe people out. So they are stop loss hunts. And then, of course, we're looking for recovery past that 20,500 level. And if that happens, then it could be signaling, again, with the rest of the broader market that things are on the improve. So, again, some structure forming. Would you agree with that?
Yeah, no, absolutely. Absolutely. I think that I think it's trying hard. And look, consolidation and a little bit of flattening, and let's call it a dull market, is probably what we need, a bit of a dull action right now to give us a little bit more stability at some of these base levels. Because we say this all along, we've said this for a long time, a market that is falling out of control benefits no one because it can be difficult to trade. And it can also be just as difficult sometimes to get back in on the upside without trying to guess where the bottom's going to be. So a dull or consolidated market, if you like, at these key levels for a while is really what we want to welcome right now, is because that will give us a chance to understand that the market is starting to find a base and it turns around. That will give us a chance to actually get involved in it far more, at a lower level than we would otherwise, when a V-shaped reversal could be huge.
And don't get us wrong, guys, as well. If you look at this percentage I've got here marked, it's still 6% in a couple of 8 hours of candle. That is ridiculous by any standard. But this is still what we would call consolidation after that huge drop. So obviously the markets are absorbing their move. Let's go over to Bitcoin. I think with the crypto markets, you've really just got to look at Bitcoin. Obviously, we dropped below the previous lower lows, and currently Bitcoin is no doubt in a downward trend. Again, what Tyrone was mentioning before, which is you've got to recognize, we see this double top style Wyckoff top. We obviously reject, we come back up, we test, we fail, we make a series of lower highs, we fail again to get past any of these points. Some areas that you want to be looking at in the future is going to be 88.5, and also I think the high of the previous two sessions, 81.3. But at the moment, for how I look at it anyway, Ty, it's still in a downward trend. There's no doubt that there are no real buying pressures here we've got so far. But that being said, if we suddenly get above 81,250, then we're starting to put in like a effectively double bottoming pattern, and that a very good level to be breaching past. So what do you think about that? I've always said Bitcoin's the best in terms of the technicals in crypto, and I don't mind the base if it does break through the high here of 81.4.
Yeah, I think it's doing a really good job. I mean, under the circumstance, I know it's fallen like everything else has, but it's playing the technical game really nicely, I think. And there's not a lot of cryptos that I would be confident trading technical analysis on, but I think Bitcoin is one of them now that you can safely analyze the markets, because there's enough volume now, there's enough users, there's enough volume, there's enough trading liquidity to make it actually viable. And I think it has been for quite some time. And although it looks like it's been a crazy fall, if you go to the smaller time frames, you can see that it's actually played the game quite nicely in terms of technical patterns. And this is no different. I think this could be a very, very solid base for it. And really it proofs all the way up to 88,000, which is the next very heavy resistance zone if this double bottom actually plays out. So it's a pattern proofing itself again. And we love those, as for all of you who have been with us for a long time know, we love patterns that proof themselves into a heavy support or resistance zone. And in this case, that level is around that 88,500-ish. So yeah, potentially a really good trade here. And I think it's probably giving us a consolidation, maybe even more so than some of the others, Tom. We have a little bit more confidence in it.
Yeah, I think a nice consolidation. Again, still downward trend, but could change very soon. So obviously we'll always be setting alerts and be ready for these types of levels. We'll go over the DAX here, Ty, as well, just to see a very similar type of structure. Again, DAX oversold itself, very heavy sell down, very good kind of equilibrium point through here in this 19,250 area.
Yep.
We hit down, we sell brutally into it. Of course, that is a very, very large sell-off, 15% across the board. And then now we start to consolidate. So really, again, the storyline here is consolidation. We have seen some change of trend. So you can see here that we've got like that kind of upward trend. We've pulled back here, probably a fib around 61.8. If we're going to find recovery, this is where bids are going to come in. So hopefully it does, but yeah.
Absolutely. Would you mind going to the daily for a moment, Tom, on the DAX? And this is one of the reasons why I probably want to bring this up, because again, it's one of those things where the weakness was starting to set in well before Liberation Day, which is going to go down in history as a wild and chaotic day. But if you look at the peaks on the DAX, the last peak, the last serious peak, failed to make a new high. It just failed. Like peak 3 there that we've got there failed to actually close higher than peak 2. Okay, and when you look at that, and then you see a test of the 20 moving average, and then another failed attempt to get higher, where the low and the high here are lower than the previous high. You can see we're already starting to get a lightning bolt. All we needed to do was break the 20 moving average at that point, and we've got a lightning bolt on the daily, which we know is a reversal of a very high prevailing trend. And then we saw a bit of a sell-off start to kick on. Yeah, and more importantly, we were trading underneath the 20 moving average on the daily for several days in a row. Yeah, that hasn't happened in a very, very long time. And you're talking about, you know, the lows that we're seeing now. That was the last time it was doing it. So the warning signs were there that this was already tired. It was already a little bit tired well before Liberation Day. Liberation Day exaggerated any move, of course, but you know, we were only looking down from there. We weren't really looking for, you know, long trades. So hopefully, yeah, some of you saw that as well, and you were able to, you know, place your trades. You may not have got the whole move, but hopefully your, yeah, take profits on the way down were significantly accelerated. Let's call it that.
Yeah, I think in this case it was a incredibly aggressive trend. Obviously, be done pretty quickly, but jump on board this one very tough. As you can see here, you got a 15-minute. You really had to just recognize that it was selling off some form of 15-minute 20, or like you can see here how many touches it has, or an anchored VWAP. And anchored VWAP wouldn't have kept up with. So if you were in the short because of the distribution pattern, then obviously it would have been good. But if you weren't, then yeah, it is tough to get hold of it. And I think the thing is that sometimes, like, I've seen in a lot of chat communities, a lot of our comments that we're getting as well, people are kind of like celebrating that they've got puts everywhere, or they've sold the market and look how much they've done. But the problem is they've done it in an unreplicable way. So they've just sold because they got scared, and then they went, okay, it's selling. And then, yes, the market has continued to sell. But the problem is that you're not going to find this type of trade pattern that is a full, massive meltdown very often. You might find it once every 2-3 years, once every 5 years, maybe once every decade. So the issue is that with these ones is you can't really blame yourself either as a trader or an investor. And I want to say this because it's one of those things where you can't predict that you're going to get a 15% meltdown in 2 or 3 sessions. Just not statistically likely. So yeah, just remember
you're going
that,
to burn
guys,
up. Yeah, you're going to burn up a lot of puts on the journey waiting for it. Exactly. I think that's probably So as much as it's paid off, it's a bit like buying the lotto tickets. You're going to buy a lot of lotto tickets before, if you're lucky enough to win the big one. You're going to waste a lot of money buying them, and no guarantees you're going to win it. And if you do, and a lot of people who do those, they give up on selling the puts, and then that's when the big crash comes. It's a bit like lotto. Yeah, they stop buying.
I was just going to say that Stanley Druckenmiller famously tried to short the Nasdaq during the 1999 period, and obviously lost millions and millions and millions and millions of countless millions of dollars trying to do it. And then a few months later, after he gave up on it, went, oh well, I'll just kind of chill. It got absolutely crunched. So it does happen, and I think you've got to just remember this. Neil says, is there any way to watch past live Pepperstone trading techniques? Yeah, absolutely. We've got a whole bunch of videos, including some of the old ones where we went through.
So many videos, Neil. So many videos.
Yes.
We've been working with Pepperstone since 2012.
Off, change of trend. You can search them inside of Pepperstone's YouTube channel, and you'll find them there. Stuart says the market can remain irrational for longer than you can remain solvent. Yep. And one of my other favorite pseudo quotes is the market will do whatever is possible to make as many people seem as stupid as possible. So, that's why sometimes when you get good technicals and it's against everybody's opinion, I tend to like those more because they feel horrible. So anyone else out there in the chat ever had that pain? It's like, oh, I don't want to do this. I know I have to statistically, but I don't want to do it. I don't want to do it. And then you do it, and it ends up being one of the best. Hi, guys. How do you access chat? You're in chat right now. So it's probably because it's chat with us, but we do see everything. And the market can remain, irrational. That's right. So, all right. Well, we've gone over quite a few pairs here. Obviously, the general gist is that we're starting to approach very key points. US 500 will be certainly worthwhile watching today. Silver will be worthwhile watching. Bitcoin's got a potential for structure if it starts to find stuff. Really, it seems like at the moment oil is probably just like declining. But, like anything, as Ty said, the difference here and why we want to make this video today is really just to reiterate that this is a fast-paced market. The VIX remains above 51. When you have a VIX this rarely above this kind of point, it means that 5, 10, 15% can literally move on indices and pairs within a matter of minutes and hours. And that means that you have to have protection. So obviously make sure you trade with protected positions is where people often come undone.
Absolutely. And I think my takeaway from today's session and probably the theme of the week is just be very, very mindful that whichever direction you're trading, the entire market can reverse on a signature here. So just be very mindful of that. And you can't predict the signature. Okay, so just trade carefully is what we're trying to say. This is not like the COVID sell-off where there may not have been a resolution as fast as people would have wanted. There was a lot of uncertainty there. Yes, there is uncertainty right now, but it can be fixed with a signature, and that's just something to be very mindful of. It's the first serious crash of this magnitude that can be fixed instantly, and that's something to be mindful of if you're trying to really short it from here. So just be careful.
All right, guys. Thank you very much from all of us here at Pepperstone. Much appreciated that you came out and spent some time with us today to talk about everything that's going on. Obviously, anchored VWAP, patterns, and of course, remembering the trend. When the trend changes, that is the key. But at the moment, in many of these markets, the trend is still theoretically down. Thank you so much. We'll see you next week, same time, same place. Bye for now.
Thanks, everyone.